Good morning, good afternoon, good evening, wherever you're in the world. I'm Nicolas Véron, and it's my pleasure to introduce this new session of the Financial Statements series at the Peterson Institute for International Economics. And today we will talk about liquidity assistance to banks by central banks. There is a debate in the US about that. We want to frame it in its international context, and for that, no possible better speakers than Andrew Metrick and Cornelia Holthausen. Andrew Metrick he initially graduated from Yale in 1989 with a joint bachelor's and master's degree in economics, and got his PhD at Harvard in 1994, probably worth mentioning because it's such a glory that at Yale he was a research assistant for James Tobin. And then Andrew became an assistant professor, first at Harvard, then at Wharton at the University of Pennsylvania in 1999, and then at the Yale School of Management, which he joined in 2008. And since 2018, he has been the Janet Yellen Professor of Finance and Management, which is quite a program at the Yale School of Management. Andrew has worked a lot on public policy and on financial services policy. He joined the Council of Economic Advisors at the Office of the President of the United States in 2009. He became its chief economist in 2010. And when he came back to Yale later in 2010, he established the Yale Program on Financial Stability, a flagship program of which he's a founding director, and where he has taught on the global financial crisis jointly, I think, with Tim Geithner, which must have been an experience, and has continued to do a lot of policy work, including last year for a number of months at the US Treasury as senior advisor. Cornelia Holthausen got her PhD in finance at the University Pompeu Fabra in Barcelona in 1999. She then joined the ECB, first in financial research, then Deputy Director General for Market Operations in 2012, Deputy Director General for Economics in 2020, and since late 21, Director General for Macroprudential Policy and Financial Stability. So that's a unique combination of recent experiences in market operations, economics, and financial stability, which are all enormously relevant to our theme today. I should mention that Cornelia is also a member of the Advisory Council of the Florence School of Banking and Finance at the European University Institute. And with that, Andrew, over to you.
Thank you, Nicolas. I'm just going to share my screen. Are you able to see my screen, I hope? Yes?
We see it.
Great, thank you. All right, so let me go forward then. Very pleased to be here to talk about emergency liquidity, and I have 10 minutes, so let me do this. Let me try to see if I can do it efficiently. First, statement of the problem, something that we now understand from what happened a year ago, almost exactly a year ago. The regional banking panic of 2023 demonstrated that the emergency liquidity infrastructure in the United States is not fit for purpose for handling 21st century runs. There's intertwined reasons for this. They connect with each other. First is outdated operational capabilities by both the Federal Reserve and banks. So just to recall, a year ago, Silicon Valley Bank failed, then Signature Bank failed. A few weeks after that, First Republic Bank failed in the United States. Those are 3 of the 4 largest bank failures in the history of the United States, and they all happened within 6 weeks. And of course, over in Europe, a small bank named Credit Suisse failed. That's the largest bank failure in the history of the world. So we had a lot went on last year, and it was clear afterwards that when these banks needed to borrow because they were facing some runs in the United States, the operational capabilities to do that were just not really there. Banks hadn't practiced. The Fed hadn't really forced them to practice. The Fed's operational stuff was clunky, et cetera. Okay, banks think of, this is a nice acronym here, FHLB. FHLB system is the Federal Home Loan Bank System in the United States. And for people who are not familiar with it, if you look into it, you'll think it's really bizarre, and you will be right. The Federal Home Loan Bank System is almost like a parallel system to the Federal Reserve, But of course, it's not a central bank. It can't make money, but it does coordinate lending for banks. It enables them to borrow effectively through the Federal Home Loan Bank system, and they can do so more cheaply than they can through the Federal Reserve's lender of last resort function, which is kind of nuts. And so that's why they're not really ready and don't know that much about how to get money from the Fed, because they tend to use the Federal Home Loan Bank system. The third thing is that the Federal Reserve in the United States does not give banks any credit, any real benefit in their regulatory rules for being prepared to use the discount window or the lender of last resort function. There's no place where if a bank says, we're ready, so take us off that operational bad list, that the Fed says, okay, great, we will give you some credit for that by saying you don't have to hold as many high quality liquid assets or some other form of regulatory relief. There's really no incentive for banks to fix these problems. And for all of these reasons, there's an overriding problem is that if you borrow from the Federal Reserve in the United States, there is significant stigma attached to that. The markets don't like it. The markets think that you're not behaving yourself well. This is less of a problem in Europe. Somehow Cornelia has managed to fix this, so it's a bit better among our European friends. But in the United States, it's bad, and it's been this way for almost 100 years. And altogether, we need policies that fix that. So what are the rumored elements here of the solution? The New York Times last week, I think, or 2 weeks ago, reported that the Fed is considering a new liquidity rule in the United States with 3 elements. The first, which is really quite radical, is requiring banks pre-position some collateral. So every bank will have to take some of their own collateral and give it to the Federal Reserve in advance, so it could just sit there and they could borrow on it at any time that they needed it. This would be quite radical. They've never been forced to do it. Many banks do it voluntarily, but they've never been forced. They would emphasize that you have to have much more of that relative to the amount of uninsured deposits that you have. That was a big problem in the regional banking crisis we had last year, was the amount of uninsured deposits, that is deposits above the $250,000 deposit limit in the United States. We want to make sure that if you have a lot of those, you pre-position more collateral. And then finally, right now, there's a rule, it's a global rule, the liquidity coverage ratio, known as the LCR, which is like a form of a reserve requirement for banks that says they have to hold a certain amount of high quality liquid assets, which usually work out to be government securities. In the United States, banks are allowed to say, oh, we're going to hold these securities forever, and please do not mark them to market on our balance sheets every time we file, but yet still counted as something that they could sell if they had to in an emergency. So the Fed is thinking, well, we're not going to let you do that. Either it's high quality liquid assets that you can sell, or you can say you don't want to market on your balance sheet. These are all things that are a good start, but they're really an imperfect solution. So I think I have maybe 1 minute left, Nicolas. So,
oh no, you have much more. You have 5-6 minutes if you want to use it.
5-6 minutes, fantastic. Because this is the most important slide. I'm glad that I still have a few minutes. So what else should be done here? What can we do? In the United States, we're thinking about a few very basic things I showed on the previous slide. But really, this is going to require a lot of international cooperation, in part because the way that we handle our emergency liquidity requirements in the United States interacts very closely with the liquidity coverage ratio that I just mentioned, which is part of the international rules promulgated by the Basel Committee on Banking Supervision. So if we really want to get this right, if we really want to have banks prepared to borrow from the Federal Reserve, and thus putting a lot of collateral at the Federal Reserve in advance, so they would be able to get borrowings from it quickly, we probably need to figure out how to work this together with the liquidity coverage ratio, such that banks, instead of being required to hold collateral that they could quickly sell, should get at least some credit for pre-positioning collateral with the Federal Reserve that they wouldn't sell. This would actually enable more high-quality collateral to circulate in the global financial system, which would have a real advantage. Second, we need to consider not just uninsured deposits, but a broader set of runnable liabilities. So there's a lot of types of liabilities that show up in the liquidity rules that banks are forced to adhere to. We've discovered that uninsured deposits seem to be able to run very fast compared to those other things, but they're not the only things. Really, all short-term liabilities that banks have could go away very quickly, and so they should really need to hold the right types of collateral and the right types of prepositioning for that. Two very famous Europeans, and I use European in the broad sense because the UK, I know, is no longer quite as European as other places. But Paul Tucker and Mervyn King have come out with a very, very strong proposal suggesting that banks effectively preposition for all of their deposits. Essentially all deposits. This is a corner solution, kind of way to do this policy. I think it is really wouldn't work and would be a bit extreme, although some smart people disagree with me. But really, the idea is it is the case that we need to be a bit broader than just uninsured deposits and move somewhere in between uninsured deposits and the Tucker-King proposal. Finally, in the United States, the nexus between the federal home loan banks and the Federal Reserve, the kind of these two ways that you can borrow when you're a bank, really needs to be much better coordinated. It is horrible now. It is the case that you will actually see a bank post some treasury collateral to the federal home loan banks and then need to borrow that day, which the federal home loan banks can't do for them. So they need to get it to the Federal Reserve, and literally we cannot deal with the logistics for that. And that's kind of just crazy. The coordination between these two federal institutions in the United States needs to be greatly improved. And the pricing, the relative pricing between them needs to be relatively improved. We just wrote a memo about this at the Yale Program on Financial Stability, which happy to discuss if we have time, explaining exactly how to get that pricing right. And that is it. Back to you, Nicolas, and I will stop my share.
That was punchy and very promising for our discussion. So, Cornelia.
Yeah, thanks very much. Good afternoon and good morning, everyone. So I'm very pleased to be here. Thanks very much for the invite, Nicolas. It's a very interesting topic and very timely also. So I should start with a disclaimer. The views are my own, and I haven't discussed them with anything in my upper hierarchy. So please, so it's not the ECB views necessarily. So I really like the Andrew's analysis. I mean, I've been reading up, of course, a little bit on this topic. But what was the new element for me is all of this federal home loan system, which I've never really understood what it is. So thanks very much for laying this out a little bit. So I agree with you, Andrew, on the problem. The Silicon Valley Bank episodes exposed several issues. I think so. It is clear there was an inappropriate risk management by banks, no inappropriate supervision, and I think the report by Michael Barr, the vice chair of supervision, that came out last year was an excellent analysis of that. But indeed, one problem was the reluctance of the affected banks to access the discount window facility, and even though it exists for just those cases, where banks face temporary liquidity needs, I think the New York Fed says it's a safety valve for dealing with these liquidity pressures, but obviously it didn't work in this case. And I think, and you said that there are two main reasons for that. First, the stigma, and that's a well-known problem, and the Fed has been thinking about it for a long time, I think. And then secondly, even if there was no stigma, the banks were unprepared to access the facility. So, and I think the prepositioning of collateral is one issue, but there may have been other issues that maybe are talked less about. No, so have the legal papers been signed, and has the facility ever been tested by the banks? And I think this issue of being unprepared is also something that has increased in relevance over the last decades because of the way that markets and technologies have evolved. Now runs are much, much quicker than in the past. So in the case of Silicon Valley Bank, correct me if I'm wrong, but I think it was 40 billion outflows in a single day for one bank. And this is much higher than we saw in previous episodes. So I read somewhere that the Wachovia Bank, is it now like 15 years ago or so, they had a 10 billion outflows over 8 days. Yeah, so it was much slower. And here in Europe, we had Banco Popular a couple of years back, and they had, I think, around 2 billion in a day. So that means with this speed, there's very, very little time for the banks to prepare. And so as soon as they start seeing some signs of such a liquidity withdrawal, it's probably too late to start all those preparations. And another reason why it has become more important right now is because, I mean, I have the feeling that also crises spread more easily than in the past. And again, this can be due to social media and the availability of information. So through an information channel, maybe to banks that may have similar business models, but also through market sentiment. I mean, it's no coincidence that Credit Suisse failed the week after we had all those problems in the US. But I mean, they had a completely different business model and very different problems. But simply the market, it gets very jumpy then in these type of situations. And I just wonder whether it's more the case now than it was in the past, but maybe not. So it's a good time, I think, now to think how to improve the system and to ensure that all the facilities are in place to provide a lender of last resort function, because it's a really, really important function. So yeah, you mentioned already in the euro area. Here things are a little bit different. And that's because our framework for implementing regular monetary policy is different. And that has also bearing how liquidity can be channeled to the banks in need in case we have a crisis. So let me just elaborate a little bit because my time is almost up. So in the euro area, we have the weekly liquidity main refinancing operations. So these are open market operations where banks can borrow liquidity on a weekly basis. We have many, many counterparties in the euro system. I mean, it's almost 2,000 banks that can access this facility, and a quite broad range of collateral is accepted. And before the great financial crisis, we had a few $100 billion every week that were being rolled over. And so banks were used to accessing the system. Yeah. Right now, it's a bit different because of QE. The system is still flooded with liquidity. So we only have like around 4 billion recourse. So this would be for our regular operations, but then we also have a standing facility for borrowing liquidity like overnight. That's a marginal lending facility. And we have, and that's separate for that, an ELA framework, so emergency liquidity assistance framework. And let me just say, I think the marginal lending facility is closest to what the US has with their discount facility. Banks can borrow at a slightly now a penalty rate, but the same collateral is accepted as in the main refinancing operation. So it has the facility that was easy to use and is still easy to use, and we still see some usage even now. So and my bottom line is there's no stigma. So and I think my 5 minutes are up, Nicolas. You are muted.
Wow, you are the most time-disciplined speaker since the beginning of this series. So I'm humbled by that and by all the questions raised. So maybe back to you, Cornelia, on this question, or actually to Andrew, on the contrast that both of you gave between a very antiquated, clunky US system and something that had been tried and tested before the financial crisis in the EU. And is it really that bad in the US? How does it compare internationally with other jurisdictions? Is the EU more modern just because its central bank started in 1999 instead of the 19th century? How do you view that in terms of the global landscape, Andrew?
So I think there's really a lot of the reasons that you mentioned probably all contribute to it. We have, it's almost an original sin of the Federal Reserve, the creation of stigma. The Federal Reserve is just a little over 100 years old, and until the Federal Reserve was founded in the United States, we were in an era we call the national banking era. There was no central bank here, and we had regular financial crises. And every one of those financial crises occurred at the peak of a business cycle. And every single time there was a peak of a business cycle, we had a financial crisis. 6 for 6 in the 50 years before the founding of the Federal Reserve. Federal Reserve was founded in 1914, and the very first serious recession that hit after that, 1920, we did not have a financial panic. We had a recession, but no panic. Success. And that's because there was a lot of borrowing from the window. And then in the 1920s, banks made a habit out of it. And at the time, banks were doing all kinds of speculative activities and financing the stock market. The Federal Reserve didn't like it. They started telling banks, we're going to get mad at you if you use the discount window. And we have basically never recovered from that. So in the Depression, they had already succeeded in convincing banks that they shouldn't use the discount window. They didn't. It was a real problem for us in the Depression. And despite many efforts by the Federal Reserve in the subsequent almost 100 years now, we have yet to, I apologize for this glare. It's the wrong time of day for my Zoom. We have never managed to eliminate this stigma. And there have been many attempts over time. So some of it is just, we didn't set it up by the time we had gotten it set up and understood the problem of stigma, we had already created it. And unless we eliminate the bank and recreate the bank, we can't fix it. Europe has just done a much better job of that. From its founding, it really destigmatized the borrowing and regularized it. Now, some of that is because they understood better when they set it up, and some of it is because of the mistakes we made in the past. But I will mention, and this does matter, even right now, the Federal Reserve, bank supervisors in the United States, boards of directors of banks are very conflicted about the usage of the discount window. So it is not the case that there's a monolithic view that we need to fix this. There's many people who work at the Federal Reserve are like, oh yeah, I don't want them borrowing from us. Let them borrow from other people. They shouldn't borrow from us. They shouldn't get and they shouldn't be prepared to borrow from us. They're very bad people if they borrow from us. And until we really fix that and recognize that one of the reasons we have a central bank is so it can be a lender of last resort, we're going to continue to have these problems.
Is that associated with any particular regional feature, some regional feds, or is it a different divide?
No, it's not really. It's basically, for the longest time, they've just not, part of the reason that it's so that we don't have an operational improvement in using the discount window and that it seems like it's stuck in the last century is because some people like it that way. It's the same thing. It's the same way that we treat, sadly, in what we think are liberal democracies. We often make it very difficult for people to get benefits from the government, in part because we're conflicted as a society about whether or not we should be offering them. So it's often a very difficult process if you need to get unemployment insurance or food insurance. And I think we have the same problem. We are stuck somewhat in this notion that it shouldn't be easy.
Yeah, sorry, go ahead.
So anyway, I think it is a multifaceted problem, and it requires some cultural change inside the institution as well as just changing the rules.
So Cornelia, when I listen to Andrew, it's impossible for me not to think of a country which is not far from the ECB, and that's Germany, where the central bank has, by tradition, been very cautious or reserved about lender of last resort function, right? So can you give us a little bit of your sense of, the debates within the ECB Governing Council? I know you cannot comment on that, but the debates in Europe more generally about moral hazard, liquidity provision, lender of last resort, all going back to Herstatt and before, in light of what Andrew described for the US?
No, thanks very much. So first of all, let me just say, it sounds like the US did everything the wrong way and we did everything in the right way, and that's really not true. No, so because of the features of our current operational framework, I think that comes from the history. because of we merged so many countries. Each country had their own system. Each country had their own the financial systems. They still differ. No, there are different types of assets around. That's why we accept all of those as collateral, and that's also why we have so many counterparties. So we were in a good position also when the great financial crisis started, because we had all of that already in place. And for me, it's more, I mean, I think we have to be a bit humbled. Also, we were lucky there in this respect, and that the framework then also really lends itself to be flexible in times of crisis. And we have used that flexibility a lot also during other crises. So I don't know, the debate here, I mean, we had our big issues with emergency liquidity assistance especially during the sovereign debt crisis, when we had not only, but especially the Greek banks, which came a lot to our facility, but we also had German banks. So I wouldn't say that it's a country-specific problem. It was just that in the Greek case, I mean, it was basically the whole banking system who in the end depended on our emergency liquidity assistance. And I should say, so our ELA framework goes on top of what we have with the marginal lending facility. So these are again different rules. So the ELA we have some rules that are universally applicable, but in the end the rules are a bit loosened compared to the marginal lending facility. So we can accept any collateral basically, and also the conditions for counterparty eligibility are a bit weaker than for our normal operations, and it's given on at a national level. So risk is not shared. So if any country decides to give ELA to its own banks, that's at their own risk. So that's a bit where the monetary union is at its limit a little bit. So.
Sorry to interrupt, but the ECB has advocated Eurozone level ELA, right?
I don't know whether it was advocated, but I think it was such a difficult situation.
Hinting at it, right?
Yeah, could be. I mean, because it is very tough, for a country, especially if you have such a large share of your GDP, let's say, in on the banking side, that it's very difficult to provide sufficient ELA. And as we remember, in case of the Greek banks, I mean, it's a small country, Greece, So, and they had to bear all of this, but they went out of it very well then after a couple of years. So in the end, the episode ended well, and also the Eurosystem or the Bank of Greece didn't make any losses here. But I mean, to what end? So I was intrigued by what you said, Andrew, about that it's also a cultural thing, whether to provide this emergency liquidity assistance to banks or not. So. Because I think it's all guided a bit by these old Bait-Short principles. You should lend, so there should be an entity, the central bank, that lends to banks that are solvent and have temporary liquidity problems, but it shouldn't also be too easy in the sense that it should carry a penalty rate and should be only temporary. And I think that's what more or less the European framework adheres to. I mean, the temporary, the Greek banks had this for a couple of years in the end, and solvency is also sometimes not so easy to define, because you may have a bank that's in a situation where everything is fluent, and the liquidity issues, they can very quickly become a solvency issue. And so it depends on how exactly you define it. So I think in our framework, we had a definition that so we would provide ELA either to solvent banks or to banks with a credible prospect for recapitalization within like a half-year period. And that, of course, leaves some room for interpretation. But I think that's fine. And generally with ELA, it's a bit the difficulty, how precise you want to be on what is under which condition you give it. And because you want to enable banks to prepare for it in case of need, but you also don't want to promise too much. And you want to leave yourself a little bit of leeway because every case is very different.
So we have a bunch of questions already. Alain Laurent has a remark to start with that there was some stigma in the European Union too, because the ECB was twisting the arms of healthy banks so that they wouldn't they didn't need the money, but so that they would take the money to avoid stigma. So that's a useful historical reminder, I think. But Alain also has a question about the policy solutions that you hinted at, Andrew. Why not simply apply haircut to bonds that are held to collect? I think he uses the acronym HTC, which I didn't know, to reflect market value, fair value, and keep those as liquid assets in the liquidity coverage ratio. Andrew?
Well, that basically the way that it works now is that you'll have some high quality liquid assets, and you can and you'll have government securities, and you'll count them towards your high quality liquid assets. So I think is that the question that can I count it in my hold to maturity portfolio at the same time that I'm counting it as a high quality liquid assets? And if I'm understanding the question right, it's suggesting I should still be able to hold it in high quality liquid assets, but just with some haircut. I think that's how. Yeah, sorry.
Yeah, Alain Laurent will correct us, but that's also my understanding.
Yeah, that's my understanding. So, I mean, I wouldn't be particularly bothered by that. I think the first order thing that we need to do is less about kind of the accounting treatment of these things, which we're now very fixated on because of what happened to Silicon Valley Bank, and more just non-securities type of collateral. So loan portfolios, you can bring your commercial and industrial loans, you can bring those to the central bank and borrow based on them, appropriately haircut. Right now, though, and this is something Cornelia's worked on this over the years because Basel has come out with many different suggestions about this. If you take some of your loan portfolio and you sit it at the central bank, which is a great place for it because it's not circulating collateral anyway, it's just already sitting somewhere. If you put it at the central bank and have borrowing capacity on it, you currently won't get any kind of credit towards the liquidity stress tests that you do or your liquidity coverage ratio with some very strong restrictions. You won't get credit. And so what that means is instead of posting those types of things, we have the banks buying up government securities because they need high quality liquid assets to show that. But now those high quality liquid assets can't circulate as collateral in the overall economy, and they're kind of stuck a little bit. And so it would be better if we could somehow use the properly haircut, liquefied liquidity value of some of the collateral that we have that we know we would borrow on anyway. So it's I think less about how we deal with the securities, which the Fed is focused on, and I think that the suggestion that was made would be fine with me about haircutting them and leaving them in. But I think more important is that we allow some non-high quality liquid assets, non-government securities, to have a liquidity role if they're properly pre-positioned, properly marked and haircut.
Cornelia, do I remember correctly that this was largely the problem with Banco Popular, that they weren't able to post their commercial loan book as collateral quickly enough to help resolve the liquidity crisis, or is my memory faulty?
Yeah, so no, thanks. So that was in 2017, I think, Banco Popular, and indeed, so that's the one case I also had in mind where this really was an issue. No, so because the bank's liquidity situation deteriorated, I think they had one day when they got around 2 billion euros in ELA, and the next day they realized they ran out of collateral. And I mean, the type of collateral that Andrew just described, like loan portfolios, that's, I think, very, very difficult for a bank to scramble together or possibly to bundle to get better conditions, and also for the central bank to evaluate it, because I mean, you want to make sure that you get some quality there. And actually at the ECB, we do have quite high haircuts for these portfolios exactly for that reason, because they are relatively opaque and difficult to look through. And I think there Banco Popular was probably negatively surprised how high these haircuts were. And then secondly, they didn't manage to get it together. And then probably the National Central Bank could have started to work with them a little bit earlier, not to understand the problem, but I don't know, that didn't, I was not there. So, but it's exactly as Andrew said. So you really need to prepare for this, and in a time when everybody is busy with everything else also. So it's very hard. And I mean, at the ECB, we do accept this type of paper also in our regular framework, no? And so what we do see is that many banks, they are really over collateralized. So they pre-position the collateral at the ECB. They can use that for the weekly operations. They can use the same collateral without moving around between different accounts. They use the same collateral also for the marginal lending facility. And we see there's lots of excess collateral right now, and that in particular, we had these targeted longer term operations that ran for like up to 4 years, and so many banks have now repaid it, but they left lots of that collateral on our balance sheet, and then it is like was mentioned before. So they take the very high quality liquid assets and use them in the market, and then we are left here with a collateral that's sometimes not marketable. So I think it's a very good deal for the banks.
We're reminded by one of the participants that today apparently is the day when the bank term funding program of the Fed is ending after a year. Andrew, I'm sure you have memories of that. And this participant mentioned the overhang of large held to maturity stuff that has accumulated with a large unrealized loss. So do you have any view on it, the underlying vulnerability, to quote from the question of this large ATM pile with large unrealized loss, which is still there?
So that's a great question. The underlying problem that led to the regional banking crisis of 2023 was that it was a solvency problem. I mean, we think of it as a liquidity problem. That's how it manifested. But basically, the banks in the United States probably lost approximately half of their capital on paper over the previous year, as interest rates went up from 0 to 5%. Just marking to market long-term assets, for which banks have many, caused them to lose approximately half. Estimates vary, but approximately half of their capital, and that has nothing to do with credit losses, right? Usually, we think banks get in trouble when they've made loans and the loans go bad. That hadn't happened yet, right? This is just because of interest rate risk and interest rate changes. That has not cleared up. And if you notice, interest rates are pretty much the same as they were a year ago. So it is the case that we still have all of these embedded losses on bank balance sheets. And the worst banks, the ones that had the most exposure, both to those losses and to runnable uninsured deposits, those banks kind of went down or shored themselves up by getting more capital. But one of the things that calmed everyone's nerves was this very generous lending facility from the Federal Reserve, the Bank Term Funding Program, or BTFP, which had this really quite novel and aggressive feature of being willing to accept all government collateral at par, as though it had not been marked down. They would just
was that wise or was that too much? I mean, it's incredibly generous.
I'm generally in favor of being very aggressive in the face of a panic that could be destabilizing and cause a lot of deadweight loss. So it was successful. So therefore, I'm going to say it was good. And it lasted a year. But yeah, it was quite aggressive. I mean, and quite a new step for them to take. So it was a consequential move to make. But that's now expiring. That was an emergency thing in the United States. If we want to do the equivalent of ELA in Europe, if we want to do that equivalent, we have to kind of flip a switch and say that we are in a systemic crisis if we want to be that aggressive. And in this particular case, we did that. We flipped that switch. But it's hard to argue that we should keep that switch flipped a year later. So there is some danger, since the underlying problems of all those losses are still on the balance sheets. If we get hit by a recession on top of that, or a very bad downturn in commercial real estate, we would suddenly be panicky again, right? And so that's a danger. But I don't think the Fed has much choice. They said it would last a year, and it's hard for them to argue that they need to extend it another year right now. But I imagine they would just pull it back up again. We're all hoping interest rates fall without a recession. If that happens, we will get back some of these embedded hold to maturity losses, and the danger will go away. But it hasn't gone away yet.
Cornelia, we have a question from Marcel Magnus at the European Parliament, who's asking a follow-up query about your point that there's a special status for banks that are going or likely going to get recapitalization soon, and how that sits with European competition rules, because that means that those banks have a different status. So that's for the lawyers to a certain extent, but do you have any views on that? Because that's an intriguing question.
Yeah, I guess it's a good question. I mean, we have a 24-week horizon, I think, for banks to get this recapitalization going, and we are monitoring this very closely then also to ensure that progress is being made, so that not after 25 weeks we are all of a sudden there and see that nothing has happened. So it's a bit at the borderline, I think, but I mean, as I said, that's because we make it a temporary thing. I think it can be accepted, because often, as I said, the solvency and liquidity, they are very, very closely related at this point in time. And it depends on exactly when you take the snapshot and define what is now solvency, what is not solvency. So I think you do need a little bit of leeway there. So the temporary nature is one thing. And then the other aspect is that it's, of course, also priced at a penalty rate. No, let's not forget that. So in our case, the margin lending facility is a higher rate than the main refinancing operation. Currently, it's only 25 basis points, where it used to be 100. And then the ELA, the rule is that it has to be given at another 100 basis point penalty rate at least. So that's the minimum. And that's also, I think in the Greek case, it was all around 100 to 150 basis points on top. So it's a very costly thing. So also banks really have an incentive to get out of that as fast as possible.
So that was a question from Fernando Montes-Negret. In the Eurozone, all the liquidity facilities are provided at penalty rates without exception, right?
Well, the penalty rate compared to the weekly main refinancing operation.
That's right. Yeah. And in the US, is it more complicated, Andrew?
So that we do adjust. Basically, there is a penalty relative to the top of the Federal Reserve's target range for rates, and that will adjust over time. Right now, it's very low. Maybe it's even zero. But I want to just one mention about penalty rates, because they are very much part of the vernacular, the way that we talk about emergency lending. And Cornelia pointed out correctly that the origin of this is the writings of Walter Bagehot, who gave us the central banking Bible back in the 19th century that we're still sticking to, who said one of his rules was, lend against good collateral, lend freely against good collateral at a penalty rate. This solvency issue is not in Bagehot, but was kind of created by people interpreting it and trying to apply it. But I want to focus on the penalty rate, because I think it's important, and I think we've perhaps interpreted what it was that Bagehot's purpose was not the right way for today, and it's part of the problem in the United States. Again, I think Europe has managed this better than we have, which is Bagehot was writing in the 19th century under a gold standard, giving advice to the Bank of England. And what they were mainly really concerned about was an external drain on gold that would happen at the time of these panics. And his advice to the Bank of England, it wasn't about moral hazard. It wasn't about making profits. It was about preserving their gold. And that when you really get into a panic type situation, if you don't charge a penalty rate, you may run out of gold. And that would be a disaster if you're the Bank of England and running the whole gold standard system. So it's not the way we think about it today is like, well, you know, banks need to know that there's gonna be a penalty for this, and we've kind of mixed it up with moral hazard, but that really wasn't what it was about for Badgett. And the danger of taking the penalty rate too seriously and literally is that it really can add to stigma. And we're the ones who have managed. Europe has not messed this up, and I'm just encouraging my European friends, please don't mess it up the way we did and stigmatize your window in a way that's hard to recover from. Because once it is stigmatized, it's, you know, it's great. You're loaning at a penalty rate, but no one wants to borrow. And you really want them to borrow. That's the main thing that comes out of Badgett. You really need them to borrow when you end up in a panic. So we, like the ECB, we've made our penalty rates quite small. And in some cases, like the BTFP that is just expired, really collectively, when you look at that facility, you wouldn't say that it's a penalty facility, right? It's doing things that the private market would never do, not even in normal times.
Exactly.
Right? So, but I
don't
disagree with that. I don't, you know, and I think a lot of times what we've done in crises has not been used penalty rates, and the most powerful interventions have not had big penalty rates associated with them. And I think we need to learn, you know, why has that worked, and why do we do that, and not necessarily kind of hold Badgett's dictum, which he wrote for a gold standard Bank of England, to a fiat money regime that we have today.
And we have a participant asking a similar related question about whether it makes sense in a systemic event to lend at penalty rates, because every bank may have liquidity problems because of exogenous conditions, so why penalize them? Cornelia, do you agree with the way Andrew framed it, or was he too lax?
No, and I mean, the comment that you just read out, I can fully agree to that. No, so if you have an individual bank, then the penalty rate makes sense, even though Véron had something else in mind. But I think the moral hazard issue still plays a role. But if we have a systemic event, then it doesn't make so much sense. So I mean, I found the Fed's facility very generous. I was surprised to see it, but as you say, it worked. So we can be happy about that. Everywhere in the world that worked. But I mean, in the great financial crisis, what we did was simply, I mean, what we introduced was the so-called fixed rate full allotment. No, so and that was like ELA to the whole market. So meaning that in the past, in our main refinancing operations, banks had to bid, but the ECB was only willing to give out a certain prefixed amount of liquidity. And since then, the ECB has always been giving as much liquidity as banks have asked for.
When was that? That was as early as summer 2007, right?
2007, you're right, exactly. So when the first signs were there, you know, after Bear Stearns' failure and so on. And that summer, in the August, we introduced that, and we have since not removed it, because it proved to be very valuable to stabilize the system. And indeed, and that's then not at a penalty rate.
Well, I'd like to come back to the policy measures that Andrew hinted at the beginning. We have a question from Richard Berner, who asks you, Andrew, how should supervisors change their oversight of liquidity risk, including via stress tests? Should we scrap and rethink the LCR, which you mentioned, and also the NSFR, the net stable funding ratio, which is part of the Basel framework? Should the Fed broaden counterparty access to the standing repo facility? And I would add, because it's related, one question of my own, which is what has to be rethought at the Basel level, at the global level, as opposed to US specific considerations. And also Ted Truman asked about whether increasing capital is effectively the same as what you have mentioned, or how to think about the interaction between capital requirements and what you mentioned on especially haircuts.
Okay, those are great questions, and from friends of mine, Dick Berner and Ted Truman. Just for people who don't know, Ted Truman was actually Janet Yellen's teaching assistant. He taught her when he was a graduate student, and she was a graduate student at Yale. So he taught her well. Thank you, Ted. So let let me start with this issue about Basel and how the international standards might need to interact with these things that we're discussing here in the United States and maybe elsewhere. So as Nicolas pointed out, there's two components to the liquidity standards. One is called the liquidity coverage ratio, and the other is called the net stable funding ratio, or NSFR. My understanding right now is that most banks don't see the NSFR, at least in the United States, as being binding. And it's really the LCR, the liquidity coverage ratio, that tends to be the binding constraint when there's a binding constraint. And basically what the liquidity coverage ratio does is it says you have to hold a certain amount of things you could sell that are also very liquid as a function of just how much stuff you have that might run away from you. Okay, and that's what it's saying. At the time that this was passed, now back more than 10 years ago, Australia actually did not have a whole lot of government debt, right? Australia was running budget surpluses, didn't have a lot of government debt. So it was going to be difficult for Australia to have the high quality liquid assets there. And so a compromise was made at Basel, which was essentially saying, all right, well, you can get credit for pre-positioning collateral towards the LCR, but we have to make sure that you're being charged a lot for it. I think the number was 75 basis points or something like that. And that number proved, now Australia now has some government debt, so this is no longer an issue for them. But that compromise that they did there was a very interesting idea, but it turned out to be too expensive. And the private markets can do it cheaper. Okay, so effectively what happens a lot in the United States is that a bank will take its loan collateral, which is illiquid, it will hand it over to, let's say, an insurance company in a swap. The insurance company will hand the bank high quality liquid assets like government bonds and charge them something less than 75 basis points. And the bank gets to count those securities towards its high quality liquid assets. Now think about what happens if that breaks, right? If that breaks, it's now insurance companies that have all this illiquid stuff. They don't know what to do with it. And if they have liquidity needs because the bank can't give them, the bank has needed all the stuff that they gave them, the insurance company is now going to show up at the central bank and say, help us. And the central bank's going to have this enormous problem because it's never looked at this collateral before and it doesn't loan to these counterparties. So it would be much better if we skipped the middle institution and we just did all of that at the central bank. And we could do that if we just took the rule that was in the LCR of 75 basis points and lowered it down to below what costs in the private markets to do that, right? This is a big, huge accident waiting to happen. So big picture, the liquidity coverage ratio and the way we think about it from a Basel perspective, I think needs to take into account things that the private market has done as workarounds and figure out a way to make them simpler and more stable. And that's the big picture. Then the devil is in the details, and experts like people who work for Cornelia that she'll be sending off to these meetings need to make sure that we get those details right. But I think that's a really important thing. Now, there were several other questions Dick asked, because he understands this debate very well in the United States. He asked a lot of hard questions, which I'm not going to answer because they're hard. About what counterparty should we have at the standing repo facility? These are quite difficult, thorny questions. He didn't ask me the easy ones. But I do think that and he did mention the LCR, that's going to be the important thing that comes out of the international side. We can't just do that by fiat in the United States. I do think we, however, do need rules about these things that apply to banks well below the Basel thresholds. So in the United States, we at least need to go down.
Is there such a thing as a Basel threshold?
Yeah, well, 100 billion, right, exactly. In the United States, we have the threshold. You guys are pretty serious about it. But here in the United States, you don't have the Independent Community Bankers Association, which is a very powerful lobbying organization. Which
we have the Sparkassen. You don't know them, but they're interesting.
Are they as good as the ICBA? I don't know. They're very powerful. But yes, we need to go down and apply the rules much lower. That's a very important thing. And at the very least, we need to apply stronger liquidity rules, even if it's not the full Basel.
Cornelia, how do you think about the Basel agenda? The ECB is a full member now, so what part of all the stuff should Basel take on?
So I think one key lesson, I mean, as was already alluded to, so in the European case, for instance, the Basel rules apply also to smaller banks, no? So that's the good side of it. But I have the feeling a lot of people are a bit concerned about the appropriate supervision. So I think supervision really needs to be strengthened, and I would imagine that also this is being looked at in the Basel Committee. And I think you mentioned the stress test also in the very beginning. That's something that the banks in question in the US, they did not have to undergo stress tests or less regularly than the larger ones, for instance. So I think that's a really important elements. I don't think there's much appetite in changing the liquidity ratios. But I mean the G30 report, no, I don't know whether it was already mentioned earlier, which I thought was an excellent report, and I can only recommend it to those who are here listening. I mean, I think they made a proposal to look at a shorter time horizon. No, I mean the LCR is a 1 month. It looks at 1 month outflows, and we know now that this is too long. No. So maybe you could think about having an additional shorter term measure, and this is, I think, what the G30 report is also looking at, to have something that considers outflows only like over a week or 5 days or so, and that in particular also taking into account that depositors behave in very different ways. Yeah, so some are very runny, like the uninsured, and then others are super sticky. So we see banks that are almost failing, and people still keep their cash there, which so they're very different. So it does make sense to have a rule that takes that into account and has more demands on the bank if a lot of their deposits can easily be withdrawn.
Andrew, I'd like to have your take on this idea that things are faster now. I mean, at Yale, you teach together with Tim Geithner, as I mentioned. I mean, I remember late September, October 2008, things were moving pretty fast, or at least that was the perception at the time. So have things really changed now that we all have smartphones, or is that largely a distinction without a difference? How do you look at that?
I mean, the evidence seems to be that the runs in March were quite fast, even by historical standards. And that's even in a world where runs are fast, right? Runs have always been fast relative to the technology that was available. 19th century runs were pretty fast. You looked out your window, you saw people lining up at the bank, and you got online. And you know, it might have taken a little bit longer than with the smartphones, but it was still pretty fast. So I do think I agree completely with Cornelia. We can't, you know, the LCR in thinking about 30 days is just, it's not going to cut it, right? We need to rethink that for sure. But you're also right, Nicolas, which is that the wholesale runs that happen in non-bank financial institutions, those have always been faster than the depository runs.
In a way, wasn't that Silicon Valley Bank? I mean, it was a wholesale bank by billionaires.
Yes. It was very much like a 19th century throwback in many ways, because it had almost no insured deposits, and it had pretty sophisticated depositor base that made it more like a wholesale finance operation. So I think that a bit part of the problem is that an ethos grew up in the United States that Silicon Valley Bank was just a liquidity run, and it was just because everybody had fast trigger fingers. But no, it was an insolvent institution. So the run was not a crazy, panicky moment. I do think we need to prepare for somewhat faster runs, but you are right. Runs have always been fast relative to the technology we have available. Problem is our technology for dealing with the runs has not gotten any faster. It's still very clunky and old. And the runs, if anything, have gotten faster.
So I'd like to conclude, because we're getting close to the hour, with a consideration of the rest of the world. We've been talking mostly about the US and the Eurozone. Cornelia, you referred to some of the dynamics within the Basel Committee, but in terms of this theme of emergency liquidity, and also, we're not talking here about liquidity in resolution, which is a very important theme mentioned by Alain Laurent and Dick Berner in the Q&A, but we won't have time for that, so that will be another session. But for this emergency liquidity to basically solvent banks or presumed solvent banks, Are there experiences in the rest of the world that you're looking at? Have other jurisdictions big lessons to teach us, or is the format of this session Eurozone and US basically capturing the global debate? Maybe starting with you, Cornelia.
Yeah, and I must admit, I'm not so aware. So we are really looking quite closely at what the US is doing. And but on this emergency, and we have, of course, also contacts to other banks, especially the larger central banks. But now I don't know about the emergency liquidity assistance. I really couldn't tell you much right now.
What I can say is that among other developed countries, Japan is quite good at this, and it's in part because the Bank of Japan has a lot of power to do what they need to do when they need to do it, and they've been pretty successful in that regard. For a lot of emerging market economies, the liquidity issues that happen really sharply tend to be about lacking dollar or euro liquidity, as opposed to liquidity in their own currency that's very easy for them to create. So the action there is in thinking about swap lines with major central banks, and less about it's less about their individual institutions and more about their problems getting dollar or euro liquidity. There, there's some that are extremely successful, but it's not my area of expertise in how to do that well. I have enough problems just understanding it when it's dollars.
But I actually have some experience with these swap lines, actually. So yeah, so you're very right. So these were super important. I mean, also for European banks, but also for Japan, Switzerland, Bank of England. No, so when we had these swap lines during the great financial crisis, and then also when COVID started, for instance, that indeed is important to have them. And even though they usually work as a backstop more than anything else.
So unfortunately, we have to stop there because we're at the hour. This was a fantastic session. I got a message from Stefan Ingves, who's in the audience, also congratulating you. You were incredibly thoughtful and candid, given the topic, so that's invaluable. Thank you so much. We'll have the next session on March 27 with Sheila Bair and Graham Steele. We'll talk about the structure of the banking sector in the US with this apparent polarization between large and small banks with the disappearance of the mid-sized regional banks. So very connected to our theme today. And again, many, many thanks to the engagement of the participants and to our exceptional speakers. Thank you very much. Have a great rest of your day.
Thanks. Bye-bye.